We begin tonight's show by making a list and checking it twice. Why, you ask? Well, because we're just 53 days away from Christmas. 53 days, 6 hours, 59 minutes, 20 seconds.
Who's counting?
Hear the music, the groans on the desk. No, we're not talking retail. We're talking the Santa Claus rally. We want to know, with stocks hitting new record highs, is there any room left for a Santa Claus rally?
That is...
Or will investors be left with just a giant lump of coal?
Wow.
Guy.
You know, along with how was your turkey day?
Well, it's not even turkey day yet.
Gobble, gobble.
And yesterday, your favorite day of the year.
And yesterday, Halloween. Love Halloween.
Love Halloween.
But the Santa Claus makes me cringe. It's like that. Did you see what I did? Said there, cringe. Bad news is, it's probably, it feels as though we're right on the verge of one. Look, bad news is good news for the market. Good news is good news. Doesn't matter. It seems like the market just wants to go higher. I think Steve's been alluding to that for a while. Here's sort of the fly in the ointment if you're so inclined. If you look at where the VIX closed today, 12 in the low 12s, this is basically the same level it bottomed out late July. Go back and look what happened in late July. So if the VIX is an indicator of anything, these have been levels where when it bottoms out here, typically the market tops out. Now, with that said, I've thought that for a while. But again, with VIX at this level, I think it's the warning signs now are flashing red.
We had tremendous price action today. Closed at the highs of the session. We had the cyclicals really rally. I mean, the best parts of the market were energy, materials, industrials.
Yeah, so you have this rotation. I mean, we've seen a lot of rotations in this market over the last year and a half, and they really haven't yielded a breakout to new highs. They've yielded some incremental new highs. This feels and maybe looks a little differently. I think a lot of it has to do with the fact where we are in the calendar is what you're alluding to. And I just make one point. Think back to this time back in 2017. We were probably having the same discussion as we went into November. And what did we get? We got some catalysts that took the market straight up. And then we kept on going into January. And I think Tim would tell you what was the most overbought we ever had in January of 2018. And we had a pretty sharp decline. So I think everything is in place if the news flow doesn't get much worse to have this thing break out finally.
But then we're headed for a decline afterwards. That's
you were waiting for the worst.
Well, so if you're looking at 17, 18, no, the higher we go right now is the lower we go next year.
See, there it is, big butt.
Got to have it. So we talked about retail, and if you think about retail as a sector, there's really been no collective part, I think, of the S&P that's underperformed more relative to its peer group. So you're down almost 20% going through the lows of where we started to dig ourselves out of. But the S&P has been, to me, I think, doing what it's been doing based upon trade or politics or the Fed. But retail has been show me. You have a lot of companies in retail that are a combination of they have these secular stories that are broken. You have logistics dynamics that are also part of it, but they're the ultimate cyclical story. So on a day when you saw that payroll numbers tell you people have jobs, that the working hours were right there where they need to be going into the Christmas season, and that's the part of the economy that has been spending and supporting the overall U.S. economy. So it makes sense to me that people should be rotating, but I would rather be in a FedEx. I would rather be in the Uber cyclicals that, to me, have valuation arguments, and if you're going for a payroll number that tells you the economy's okay, go for the places that have discounted recession.
Well, even better than that, we had Jerome Powell earlier this week tell us that the bar is extremely high for them to be raising rates. So we're going to be here for a long time.
So if I asked you all the reasons why the market sold off, I will tell you all of them are either better or not as bad as we had thought. China, earnings, Powell. So it does set up, but the big caveat, we're switching sides here, is that we're almost overbought in the S&P.
What is almost?
We're literally 10 handles away from an overshoot level. So I think that we can sell off short term in the S&P and then rally into year end. But I think we're going to have to give some back. This was much too fast.
You think so? Hi.
Well, I mean, I thought the S&P was going to top out a while ago. So I hear what Steve is saying. I mean, in terms of all the indicators, it seems as if we're getting to levels where we're completely overbought. But in terms of playing catch-up, and we're going to have the great Carter Braxton Worth on our show. And
pantheon of technical.
He's on the Parthenon for sure. I mean, he's right there. So. I mean, it really is amazing. But I think energy is really, you have this stealth rally in energy. Some of these oil service names, Schlumberger off the low. Dan's giving me the wave. But SLB's had a really nice move. Halliburton, you look at some of the refiners. Valero's had a huge move. I think energy stocks
you can't find any help,
maybe
though.
They're going higher.
Refiners are great, but E&Ps, that's where you struggle. Large integrated names, you struggle. And if you look at them just on a monthly basis, you can get something out of them. But when you look back 5 years, the only ETF that is still negative after 5 years is energy. The sector energy is still troubled.
Yeah, I was just going to mention this. You said that all the things that were concerning the market at different points of this year when we were having equity sell-off are better. You know, listen, that can change on a dime. We know that. Let me tell you what I think is kind of different, though. I think the fact that we did not see yields go higher on a day like today, when you saw the data that we did, they probably should have in a way. When you think about that this week we got the third consecutive rate cut since July, which takes out a third of the increases that we've had since the Fed started raising rates a few years ago. To me, and I know that Peter Bookvar has made this case very eloquently this week, any cuts that we get from here on out are going to be addressing global economic weakness, not this kind of insurance sort of setup that this is what the Fed really set to do, this mid-cycle adjustment. So from here on out, with rates going lower, then I start getting concerned about what that means about global growth and growth here. And we heard a lot about economic data stabilizing this. That manufacturing data did not tell us that. I don't think the jobs number was as strong as the S&P up 1% says it was today. If you look where those gains were coming from, that sort of thing. So to me, I don't think it's that impressive.
So you're saying that you're concerned that rates didn't go higher on a day like today. Rates actually were up. I'm not trying to correct you in public.
A little bit.
I'm trying to tell
you are.
That ultimately.
But they're down week over week.
I'm trying to understand. Are you telling me that you're worried that if rates continue to head lower, that's a terrible sign, and that's everything the market was discounting?
I'm telling you, if the 10-year Treasury yield goes back and tests that 145 level that it was at a couple months ago, that is not going to be a good thing for U.S. equities.
We have a split screen here, and I would make an argument that actually, we tested that 50-day on rates, and actually we bounced a bit higher today. So, to me, ultimately, the market, I think, has discounted that the Fed could do almost nothing until mid-2020.
I know, but
and that's a case where, for equities, though, but I'm agreeing that we want to see rates going higher.
I guess my point is that we keep hearing about this rate differential. What's Europe going to do? What are all these weak economies going to do? They're going to continue to have accommodative monetary policy that's going to continue to put pressure on the rates. And that is one of the reasons why
Europe's
outperformed the United States.
And you're still going to have people get pushed into equities, though. So if that happens, I think you're going to wind up, the net result is that they're going to look for growth and where they could find it. And that's going to be probably in the equity market.
Probably, or maybe not.
But think of all we've discounted.
Still go back to
We've discounted recession in Germany for 2 quarters. We've discounted, Hong Kong PMIs. We know what's going on there, but we're at 43. They were
Hong
at
Kong,
March of 2000.
South Korea.
So,
I mean, the list goes on
but isn't that well in the price? And if you have central banks that are throwing everything in the kitchen sink at the problem, you're going to start to get some
well
stabilization.
in what price? In the
Dare
price
I say, Guy?
In the price of equities?
Green shoots.
Oh, stop,
green shoots.
Please.